Hey, hello folks. Welcome to Pro Trader Strategies. This is Swing Trades Using Options. My name's Eric Wilkinson. Let's get this on. Wait, before you go though, make sure you guys smash that like button. If a light bulb moment happens to happen for you folks, hit that like button because it sends a bot out there into the web and finds a person that looks just like you. Well, at least considered to a bot. Anyway, before we get started, I've got my jacket on. It's freezing in here. I'm down in Arizona and it's unseasonably cold down here. Yeah, I'm refusing to turn the heat on. Some of you folks up north are probably like, he's crazy. It is what it is. I didn't think I'd be cold and all of a sudden I started getting chilly. So I threw on my Board of Trade jacket. Anyway, members only. It's the members only. Yeah, some of you older folks might get that. Anyway, let's get on with this. We're going to be talking about swing trades, and I'm going to be then talking about how we layer on top of that option strategy. So before we get on, make sure you guys subscribe in case you get lost here. Subscribe, hit the little bell right next to it so you can get these unannounced videos that I do. This one is pretty much scheduled on time. All right, so first off, like I said, we're going to talk about swing trades. Then I'm going to talk about why we want to use option strategies around swing trades, the benefits of that. And then finally, I'm going to talk about a strategy specifically appropriate for the underlying we're talking about. Now, and that has to do with our directional assumption we come up with in this swing trade video. So first step, talk about swing trades, what we identify with that, why we're going to use options, and then more specifically, the option strategy that is best suited. I think I said that a little bit better. I'm glad I repeated myself there. All right, so first off, swing trades. What is a swing trade? Well, a swing trade is pretty simple, folks. There's a couple of components to it that we'll talk about here, and then we'll dig into the details a little bit later on. Because I like to, folks, with my videos, I try to build from simple concepts and then layer on the real life examples. So we'll try and keep it simple and then add a layer of complexity to it that hopefully will just make that click in your mind. So if you like that, smash that like button. All right. So first off, what is swing trading? First off, we have a market that might be in a bullish trend, right? We see that all the time. Right now, the stock market is in a bullish trend, right? And then we'll look at market neutral trends, all right? That's when they're trading sideways. They really don't go there. IBM's the first thing that goes off in my mind. And then we have stocks that are in bearish trends. Well, we've got Baidu. It's been in a bearish trend for a while, so we can look at things like that. Well, that is the first thing we come up with. Directional trend. Bullish, market neutral, or is it bearish, right? That's the overall trend. Kind of think about it as, well, if you're looking at a daily chart, it's the entire year, all right? If you're looking at, a 30-minute chart, it's that entire page in a sense. And then what we're looking for is what the market does during that bull trend, right? We always have ebbs and flows in these markets, and that's what we're going to be looking for here, is the ebbs and flows. So we can see that happen in probably even neutral markets, right? You see it happen kind of like that, or even in bearish markets where we see this happening, okay? So that's the next step, is to kind of figure out what the market is doing, because that leads us to finding where it loses resistance to the upside, meaning the buyers stop playing around. Well, when it loses that momentum to the upside, we call that resistance. And then when the market comes down, I usually say for higher risk tolerant folks to go to where you can get it to touch as many spots as you can. That's where you're going to kind of look at as your support, where it loses that momentum and comes back in. Otherwise, lower risk tolerant folks try and go out there to where you can clip a couple of them, right? And that's usually where we'll say that support level is there then. Again, for a market neutral, I'd probably come somewhere right along that way. And then, here on this one, if you have a lower risk tolerant appetite or newer to trading swing trades, trading options, then I would pick, that higher level. You are going to have less opportunities, but you're also going to be picking the higher probability opportunities. Okay. So when you're getting involved with a higher risk or a lower resistance or higher support area, those are going to be giving you more opportunities, but you might have a couple of them where they're kind of pinching you a little bit or a bit of a thorn in your side. Now, there's nothing wrong with that, especially for like traders that have been around for a long time and are accustomed to trading around swing trades. They know every trade doesn't go their way. And that's where we need to be a little bit more mechanical. Now, I don't talk about, strategies around these underlyings that might be going against us so much in here, or when we have a option strategy here that might not be working well. I have other things that we can layer on top of that, these strategies, in order to make sure that we can increase our probabilities of success there. So that shows up more in those spotting the trade videos that I do in the morning. So please check those out if you want to see more about how to be mechanical with trades that might not necessarily be working out. Because listen, folks, I don't cherry pick trades. I trade and talk about those trades. That's what I do, right? There's nothing magical about it. I'm not cherry picking anything. I'm talking about my trades, when, where, and why I put those on. And then we see what happens. We go through the process when things aren't working, how we're gonna attack that, what kind of strategy we're going to have around that, or are we just going to pull the ripcord and blow out of this trade, which is okay. There's nothing wrong with blowing out a trade. All right, so back to this. So, all right, first thing, right, we talked about the trend. Now we're talking about support and resistances, finding the support here and the resistance up there, all right? Second step there. Now, what we are going to base our trade on, folks, is not really any of that, but really with a pattern reversal off of a resistance area, or the pattern reversal off of a support here is really what we're going to key our trade in on, is that movement off of the support and resistance. And that pattern reversal is what we're looking for, right? Because here we have a market that's going bullish, hits a resistance area, and that pattern reversal to bearish is what we're looking for there. And this would have been a bearish move to a support. And then we're looking for that bullish move off of that. Okay. So those are what we're kind of looking at. Now, today, just so you guys know, we're looking at this broken wing put butterfly, which is generally a very market neutral type of strategy. Well, what we're doing is breaking that wing of that butterfly, and that allows us a little wiggle room. All right. And we're going to talk about that. But with the put butterfly, know that we are looking for a bullish, slightly bullish. We're worried about the bullish move, right? I've got a market neutral trade here. I've seen it just trade sideways forever, and all of these other levers and pulleys keep it kind of stuck in a tight range. But with that said, I'm a little bit worried about upside in this underlying, okay? So when you're going through your thought process, everybody does this when we're trading, right? You're thinking about your risk reward, and you're also kind of worried about your out. Like, what am I worried about here? And this strategy would be like, if I wanted a market neutral type of strategy, the butterfly would work very well for this one. But I'm worried about upside with this underlying I've been betting today. So that is leading me to break the wing on this butterfly to get rid of all upside risk. And we can do that with these butterflies. All right. So for instance, we used our simple concept, bullish, market neutral. Well, this is if you looked at this underlying right now, it looks like a very market neutral strategy, right? It's traded sideways for the last year. And this is a story I tell them basically every time I have an opportunity. I started trading with IBM, folks. So you and I, like if you're a newer trader, I started trading IBM. And it was based on the fact that I bought it because I loved the company back in the day, but it never went anywhere. So I got frustrated with the fact that I had this underlying that only traded between $100 and actually it was like $95, $90 to about 110, and then would retrace back. So every time it got up to 110, I was like, man, I should have sold it, right? I should have gotten out. I know it's going back down to 90 where I could buy it. Well, that's when I had a light bulb moment with my banker, and he said, why don't you start trading options around this? You can do covered calls and then sell puts to get it back. Well, brilliant. right? Especially with an underlying like this that pays a really good dividend. So you want to own the stock. Well, how do I get a really good second dividend? You sell covered calls, right? And if it gets called away from you folks, you start selling some puts, waiting for it to come back. And you can sell puts all day long. I'll show you in this example, to be quite honest. All right, so when we're looking at this, to get back to this, what is swing trading? No, we got that. There we go. Real life example, Eric. All right, here we go. Sideways, normal sideways trend here we got going on. So what I would suggest to do is really just kind of draw your line like this when you're doing this, right? This is what a market does. And then I didn't mean to go quite that far. I wish I could have erased just a little bit of that line there. But can I erase just some of it? It's not going to let me erase some of it. I'm just going to erase all of it. So now we've gotten that whole market neutral kind of trend, right? Now what we can do is I've got Fibonacci's up here. It's making it a little bit easier to see those resistance areas, but we don't always even have to do that. You can just draw your line along here and say, I just hit all those tops. And being an aggressive trader, I would have probably gone along through here. Now, less, risk tolerant folks would probably go up to that line, because you could draw a line right off those tweezer tops there. And again, down here would be your other line. All right. Not a whole lot of opportunities on those further bands, as you can see, but you didn't take a lot of heat either. Or you wouldn't take a lot of heat picking those lines in the sand as well. Now, when I'm looking for pattern reversals, folks, this is what I look for, especially from a beginner, like 101 swing trading or candlestick trading 101. These are candles that are very important, top of mind, that you should always keep your eye out for, all right? Especially when it's at one of these support and resistances, that's really major, but or at the top of a move, like outpaced. What I mean by a top of a move, like not happening, and I don't care about what's happening in there. That's the middle of the move, right? But here, over the last 52 weeks, we could easily see that this looks like it's an area where it's approaching that resistance area that we need to be keeping our eye on. So the next thing we want to do after that is look for these key candles. All right. And they always look a little bit different, but you get the gist of it. Basically, we've got a long wick with a bit of a base down here at the bottom. We call those a hammer. So something like that at the top of or bottom of a move. Well, we've got one of those right there, a hammer at the top. Another one to look for at the top or a bottom of a move is one of these. And that's like a Hangman Doji. Sometimes these dojis can, and they have different names when they get a little bit of a wick hanging out of it there, and on the bearish one, we could have a little bit of the wick hanging out at the bottom, right? Spinning top doji, tombstone doji. Now, keep in mind, all of these candles could be written in, these could be in green. So for what I'm saying is like that green candle could look like this at the top or a bottom of a move, a hammer candle, or with a little bit of the wick at the top, right? Spinning top doji. It's got a little bit of that wick hanging out, or like the tombstone doji. All right. So those are four key ones that are the major ones that we're looking for. You could look at like another one where a pattern reversal might look like, since I got the green, I'm just going to do it from the top of a move. You get a big green candle like this going at the top of a move or at the bottom of a move even. And then the next day, if you get something that, for some reason my mouse has disappeared there. Where's my mouse? Why is my mouse disappearing? Sorry, folks. There we go, green. I want it to go to red if I can. I don't know what happened there. All right. But anyway, what I was going to try to get to is to a red candle. Let's see if I can get it to change colors for me now. There we go. And then the next day, finally, I had to act like I was going to forget about it, and it gave it to me. The next day, you get a big red candle that engulfs the previous days, we call that a dark cloud. That would be a pattern reversal to the downside. That's a little bit more advanced. But really what we're looking for are these topping patterns. And the other thing is, then you're looking for that. That's what a person with a high risk tolerant appetite would do. Base their trade, come in that day and trade off of that candle there. What I want you to talk about, or what I want to talk about here is if you have a lower risk tolerant appetite, right? So newer to trading options, all of that jazz. And you were trading off of this pattern here, pattern reversal. All right, high risk tolerant person, somebody like me would probably enter a trade, a bearish trade based on that candlestick setup and all of the other things. See, we've got another one way back here that looked like that too. But if you are newer to trading options, wait till you get a red candle that then it closes out below that low of that previous day, okay? So a red candle closing lower there, that signals a confirmation that tells you, hey, this topping pattern is legit and too legit to quit, right? But, if you had waited, I entered a trade up here on this one. We had really high volatility in this underlying. So I was up here selling some short calls up there at the 137 area, all right? Now with this one, let's go back to a new example. I want to take a look at this one. I see a overall, all right, looks like I got my pen, overall bullish trend, right? Now, it's a little bit messier, but I could probably draw in a line right along those lines for me. That would be a trend, and then try and hit as many of those as I could along the bottom. That would be my kind of trend area, all right? So that's what I'm looking for. Now, with this Alta, you can see I got a bit of a bounce off of there, all right? This would be somewhere where I would be looking as support on a sideways move, because really what I'm looking at here with Alta, you can see after their earnings, they kind of consolidate sideways for a little bit. Yes, it's in a bull trend, but there's also a sideways trend within this. Now, this is a little bit more advanced. I don't expect everybody to pick up on this right away, but these are things that you kind of want to look for going forward when you're trading on these. As we can see that it pops up, it trades sideways. Pops up a little bit, trades sideways. So on this, I'm feeling like we're going to see this start to trade sideways here a little bit. And I'm going to pick, a lower risk tolerant person should pick that bottom wick. Here we've got a double top. So that's a good top to look for. And I think I've got a market neutral strategy here, or a market neutral assumption. Now, one thing I know is this is in an overall bull trend for the last year or so. So it'll probably remain in a bull trend, at least for the foreseeable future, right? So with that said, I want to eliminate risk. I want zero risk to the upside on this trade. I've got a market neutral assumption. I'm not really worried about the downside whatsoever right now. This is just me, folks. I'm not trying to speak for you. I'm just going through, like a daily process and I believe you probably all kind of follow along with this, right? You look at the charts and you're trying to figure it out and you're just trying to read the tea leaves. Well, this is what we do. And it's not always exact, but we can eliminate a lot of our risk this way. All right, so double top there. I see that as a pretty good resistance area. I've got a pretty solid bottom. You can see I've found some supports there as well, going across, going back. So I think that that's a pretty solid line in the sand there. So, 360-ish is a real low there. Would be where, I see that support come in to the upside. You can see that's at right around 420, right? Would be an area that I wouldn't necessarily worry a ton about, but it's in my mind. So that's that range I'm looking for, right? Walking myself through this. So keep in mind, 420, 360, all of those right there, and we're at 400 in a ballpark there. All right. So now, why do we want to use options? I already talked about this a little bit, but I want to briefly go over this real quick. you're going to have better odds or better probabilities. I just don't want to write out probabilities right now. All right, so you're going to have better odds. You're going to have lower margins no matter what. If you guys are using stock, ETF, futures, whatever it is to trade your swing trades or just to trade around, you're using a lot more margin than you would if you were using options, all right? Even if you're trading in a margin account, okay? Now, if you've been trading in a margin account for 20 years, you might have been able to kind of work with your brokerage firm and gotten those margins lower, all right? That's something we all can work on, especially commissions. Folks, if you're trading a lot of options, you can always call up your broker and say, hey, I trade a lot of options. I want you to lower my rate. Try it out, see if it works. Give me a thumbs up if it does. But you can, folks, especially right around this time of year. At the end of the year, you're going to close out. Go in there and see how much you paid in commissions throughout the year. And if you paid a lot in commissions, and a lot's different to everybody, so if you paid a lot in commissions, call them up and say you want them to lower your commission rate. They probably will, because guess what? They don't want you to go over to whoever else, all right? So you have leverage. They don't want to lose your money out of their bank. You can get them to lower your things. And if that's all you got to take away from this, let me know. Comment over there. Comment over there if you guys were able to get your commissions lowered, all right? And then, so we got that. And you're going to have less risk with options than you would trading outrights, stock, ETF, any of that stuff. If you're trading outrights, this is much less risk, all right? You're going to have a slightly less reward aspect to it too, all right? I'm not going to get dollar for dollar like I would shorting or getting long a stock or ETF, but I'm going to have better odds, lower margins, meaning I can create more of a diversified portfolio. I can create more opportunities in other markets. I'm not putting all my eggs in one basket, because a lot of times, folks, when we're worried about how much money we have in our bank, right, or in our trading account, well, you're kind of going, all right, I'm going to either do this trade or I'm going to do this trade. What trade should I do? All right. And then you're kind of like, well, and you always feel like you're going to pick the wrong one, right? Well, when you're trading with a margin account and you're trading options, a lot of times you're able to have more and more opportunities because of those lower margins. You can just create more trades. All right. So yeah, this guy, remember me talking about this trade? Right here is where it was. We were right there. I did not wait for the confirmation. And that's why, folks, wait for the confirmation if you have a lower pressure point or a lower risk appetite. All right. For me, remember, I was selling these 137 calls just outright. I don't own the stock right now, or didn't. Blast off to the upside. Now, it hit that resistance. It tested my strikes. I was in the money. It was looking pretty ugly, but I knew, or I felt strongly that IBM would roll over, and it did. As you can see, there got another opportunity. Now, for you folks, if you had a lower risk appetite, well, you would have had a cherry trade there because it topped out and it really never came back. But I was able to stay in that trade just because I had another resistance area. I was selling calls in high volatility. The volatility was coming out during that rally. A lot of things were working in my favor, despite the fact that I had the directionality completely wrong. A lot of the other levers and pulleys that I implemented around this strategy, meaning that days to expiration, super important when you're trading options to understand what duration am I in? Am I buying the further duration options or am I buying the nearer duration options? Should I be selling further duration options or selling the nearer duration options? All of those things come into effect when we're talking about my strategies. And with this strategy, it was take advantage of theta decay and that volatility. And that helped despite the fact that this trade was going in my face. All right, so IBM, this is back there. Actually, where was that trade at? This trade was back here. And you can see that the market blasted off to the upside on the next earnings. And talking that the folks finally started accepting Azure, which is their cloud services. So yeah, it did blast off up to 150. But look what's happened. Right back down into that range, the point of control for the last year, all of those things were right back in that neutral pattern. So IBM would be one of those where you could get back into it and just look for those opportunities. It gives really good candlesticks to trade off of as well for the swing trades. Now, again, back to this. I've got my area where I believe there's going to be some support. That's going to be a line in the sand I'm going to keep an eye on. There's a couple of them, actually. I'm going to keep my eye on this one. That's right around, I'm not a very good straight line drawer. That's 380. We already talked about this area down here. It's close to 360. Just kind of coming up with some points of interest, 420, right? And we're right at 400 right now. That's right where we're at. So that's kind of the range I think we're going to be in. I'm coming up with my thesis here. Now, I want to look down here at volatility. We got volatility starting to rise here. And what I say with this volatility coefficient, it's just like a swing trade, folks. Literally just like a neutral swing trade. All right. So keep your eyes on this chart down here at the bottom. It's implied volatility. It's Vega. Vega and implied volatility are the same thing. They just have a different name in different locations, okay? Implied volatility is Vega. And after earnings, we see the volatility collapse. Well, we did get some of that volatility collapse, but it's starting to pop back up here again. And what I say is draw like a line across the top and across the bottom. Anything above the 50 mark, halfway is a sell. Above 50% is halfway. Below 50% is a buy. Below 50% is a buy. Above 50% is a sell. And the reason why is because when volatility is at high levels, we know that our option premiums are super expensive. And when the volatility is at these levels, they're super cheap. Why do I know that? Well, because volatility is the only thing that will affect the premiums of our options at any given time, positively and negatively, right? Yeah, delta can for the move up or a move down. But what I'm talking about, just at any given moment, volatility could go up or down. And we wouldn't necessarily know it by looking at the price, all right? So we know the option premiums are expensive in the option montage and the option montage is just that page where you see all the strikes and the Greeks. So when it gets up here at these levels, we know those premiums are increasing to levels we haven't seen. So that's where we want to take advantage of it, because then when the volatility starts coming out, those premiums could start coming out. And it doesn't matter what direction the underlying is going on, because those premiums are still going down relative to whatever else is going on around this underlying. Does that make sense? Seriously, comment over there, guys. If I just spoke and kind of threw some people off a little bit, I want to make sure you folks are clear of concept before I move on. So please, if you ever are confused or have a question, throw it over there in the comment section, because I'm keeping my eye on it, making sure you guys are clear of concept. All right, so what I'm going with is this volatility is relatively elevated. If we stay in a neutral pattern, that's pretty boring, folks. And then when it's boring, volatility comes out. So I'm looking at it having high volatility right now, which means those premiums are expensive. That means I want to collect a credit because when I see something that's really expensive, what do you want to do when you see stuff really expensive? Sell, right? And when it's super cheap, you're like, I'll buy all of it. Matter of fact, I'll buy 2 of them. Broken Wing Butterfly has 2 credit spreads, which gives us an overall credit. Well, yes, that is true. And I usually say there's an embedded short put spread in there, but I think I might like the way that you talked about that, John, a little bit better. Okay, so, but great point. All right, so that's what I've got going on here. Market neutral. I'm a little bit worried about upside. I've got high volatility, so I know those premiums are expensive. So the next step, since I'm worried about that upside, I'm going to go with a Broken Wing put butterfly. Now, folks, butterflies are a mind bender. okay? Because they don't always act like all of the rest of the strategies, because sometimes a short put butterfly, you actually want a big move, all right? So, well, with this one, it's a broken wing put butterfly. We're going to break one of the put butterflies, the short put butterfly, and that broken wing is what's going to generate this strategy to make it a credit, all right? So normally a put butterfly, you would do this for a debit, but we're going to break that wing and create a credit out of it. One thing to note, anytime you eliminate risk on one side of an option strategy, you're increasing risk somewhere else, all right? It's always a give and take. If you have a less risky trade, you're not going to get paid as much for it, or you have a lower probability of success, all right? Just a couple of things with options. All right, so again, high volatility, we've discussed this, market neutral, playing this to the upside. One thing to note, if we have high volatility and really high premiums, what do we want with those? What do we want to happen to those premiums? We want them to go down, right? If I sell something for a credit because I have high volatility, which begets high premiums, then I want to sell those premiums when they are, I believe, expensive. All right. Doesn't always mean they won't get a little more expensive. All right. Just like you never buy the high tick and buy the low tick, the same thing happens here as well. All right. We're never going to capture that high, super high, or that bottom tip. Maybe once in a lifetime. With that said, what was I going to say? With the higher volatility, leads us to selling options premiums, and we want those premiums to go down. Another thing we can get on our side is Theta. So Theta is more aggressive the closer we get to expiration, because he wants to steal every penny out of your pocket. You can think about it that way. The thief in the night is Theta. And he starts out, 100 days to go, or 300 days to go, and he's maybe not even realizing you're there and taking a tenth of a penny or something a night. But as soon as we get closer to expiration, that dude's taking fistfuls out of your pocket. All right. Well, if we sold something for a credit, we want that to go down in value. So we want Theta in our pocket, right? We want Theta to be helping us out. So if Theta is going to help us out, the sweet spot for Theta is 35 days to expiration. Now, that's when it gets really good. I usually say if it's 35 days to expiration, that's the sweet spot. If you get inside that and you're looking at like 21 days to expiration, it might be better off to look back out to around 45 days. All right. So 45 days in is where we're selling options. 45 days to expiration and in. All right. If it's 46, I'll let you squeeze that one out. All right, that's where we're selling options. 35 days is just really the sweet spot. Because that's where we see the Theta really ramp up. All right. So with that said, I went into that one that's as close to that sweet spot as I could find, 37 days to expiration. And I did this as a butterfly. Now, what we're talking about with this butterfly is you sell a put here. All right. So I'm looking at this 400 strike. I sell a put there, and then I go up here. What I do with butterflies, folks, just a little bit of a refresher course here, is whatever strike you're selling, okay? I'm selling this strike right in here. I'm going to say it's $19, okay? So if I sell that $19 strike with a butterfly, or that $19 strike, I'm going to look up here and see where I could sell or buy something to define this risk. Now, what I use as that metric to go up, you're saying like, which one of these strikes would you buy? I use whatever the dollar amount here is, $19, $20. That's where I go higher. All right. So it's $20 higher. I'm buying that. All right. So this is a long put spread from here to here. Right. So you would have to pay a debit if I'm doing this long put spread. That's part of the butterfly. I'm just building this out. Now, if we're doing a butterfly, we sell another one of those and would come down here to buy that one and define our short put spread, right? This is a short put spread from here to here. So that gives us a little bit of credit back, all right? Now what John David was saying is this short put spread right there is one of them, helps us pay off that other part of the spread, right? Well, the breaking of the wing is you come in here and you buy that 380 put and then come out here and sell, or sorry, you buy this twice, or sorry, I messed that up. I'm sorry. So we're short this one. I messed that up. I misspoke already. I'm looking over there. I don't see anybody coming after me for misspeaking, and you should have crucified me. So, all right. What I meant to say here, you're selling this one, you're buying the 380, right? So that 380 put defines this short put spread. So we've got a short put spread right here. Now, if I want to break the wing, what I do is I sell that put there, which gets rid of it, right? Basically, that negates that put, and then I come out here and I buy the 360. So there's a synthetic or an embedded short put spread, and that short put spread is the short 380 put and the long 360 put, all right? That's really what it is. Now, a little less confusing is now what we've created is a very wide short put spread, and that wide short put spread gave us a lot of premium to pay off the entire other side of the long put spread, which would have been done for a debit. So just to make sure we are all clear here, I want to pull up this. And just go through this again. So if we were going to do it right here, I'm just going to look at it as the 390 today. Actually, we could do the 385. It's pretty close. So let's just go with this. So we want to sell two of those, right? It's $15. So on this one, I'm probably only going to go about $15 higher, which is still around that 420. So sell two of those. Why? We got two of those. Buy the, I'm going to just go $20 higher. Buy one of those. Now I've got a $4 credit there. So I went $20 higher. I'm going to go $40 lower, which is 40. I got to increase this, sorry. So 45, and that's right around that. So if I buy that one, define it, I messed that up. Here's what I actually wanted to do. Sorry, folks. I want to sell two of those. I'm going to go $20 higher, buy this one, right? Because that's the $20 going higher. So I've got that credit there. Now, if I would have normally done this and defined it as the broken wing or the regular butterfly, I've got an equal distance, $20, right? Now, what happens here is I define this one by buying it. Now, if I go in here and I click sell that one, it gets rid of it, and then I go down and buy, it brings it back. So that's the synthetic short put spread, or a really big double, what John David was talking about, two credit spreads, meaning the short 85, what was it, the 85-65, and then the 65-45, okay? Those two short put spread, or a really wide one. However you want to think about it to get it right in your head. But basically, you build it out as an equal distance and then break the wing that you are not worried about, all right? So breaking that wing that you're not worried about increases the risk a little bit. That extra short put spread we're talking about increases that downside risk, but that credit you received eliminates all of your upside risk, right? So let's erase all this ink. So this is your regular put spread, equal distance as of yesterday. As a matter of fact, this strategy went a little bit lower today, and it actually started working out a little bit better because that volatility crept up a little bit. All right, so if I want to analyze this trade, right, we can see that we have risk on both sides To the upside, that's below here, $3.50 is our risk to the downside and to the upside. My max profit on this trade is somewhere around $1,500. Now, what happens when I break that wing? I sell that 380 put and then sell that 380 put to get rid of it, that defined risk, and then go down and sell the 360 put. That's what gets us that credit. So when we walk through this, you can see now I broke it from the 380, which was two ago, right? This was the 380 that we had. I have this highlighted because that's where I want to break it to. Basically selling that 380 to buy the 360. And I'm able to get a credit, which means I've eliminated all risk to that upside. You can see here, if it goes higher, I get to keep that credit, that $1.60 credit. It's not a ton to write home about, but it's $160. And if it stays right here, now keep in mind, it needs to settle $400.01 in order to achieve this maximum profit. So one thing with this strategy I always say is get out for 50% of max profit. Check it out. It's $2,000 max profit. I'm going to look to get out when I'm at about $1,000 if I can. Now, if it goes higher, I'm just going to let it all expire. No, if it goes higher, yes, if it goes higher, I'm going to let it all expire worthless. All right. Now, there's something I was going to say about this. Yeah, get out for 50% of max profit. You can see where, this is what it was. Build this strategy. When you're looking at this over here, risk one to make one. All right. Risk one to make one. This one is a risk one to make one and a little more. All right. So that's how I like to set it up. Risk one and make a little bit more. That's risk one to make one for all intents and purposes. I just like to have that little bit of gravy on my end, which this is set up that way. I get to keep a credit, runs all the way higher. I get to get maximum profit if we stay right here, or at least very close to it. I'm only going to get out at 50% of that max profit. All right, let's break it down a little bit further here. Now, the traditional butterfly, you have to nail the number, right? You have to hit it right there on that peak in order to be successful with this strategy, which is very difficult to do, which is why I like to have a little bit of wiggle room with my strategies. So I don't love the butterfly unless I've got a very confident market neutral assumption here. But on the flip side of that, you have lower margin requirements. You also have a lower risk, little bit lower risk on the downside because you're not risking as much money to the downside. But you, with that said, you also have less reward, as we saw, 1,500 versus the 2,000. So that's that levers and pulleys I was talking about with the risk rewards there. Broken wing butterfly transfers that upside risk from the butterfly that we saw in those analyzed and shifts it to the downside. All right. So we eliminate that risk to the upside. Actually, the upside, I'm going backwards. So for you guys, it might look backwards. But anyway, we're trying to eliminate the risk to the upside. And by doing that, we add more risk to the downside. Okay. It also will have a higher max loss. Remember this because we transfer that risk down there. But unlimited love to the upside there. Where do you pull the ripcord on the downside, Sal? Sal's asking, where do I pull the ripcord for the downside? Like, where do I want to get out of this as a loser? Well, I would get out because based on my trade, that 380 area that we were looking at, if I can find a chart that I'm going to have to probably go back forever. Here we go. So with this trade, this 380, I'm expecting to really show that support. So if it goes below that 380, Sal, this is where I would get out of this. Great question. So another thing, I wouldn't be like too worried about that though, because usually with defined risk strategies, I'm going to let those play out. But if you have a lower risk tolerant appetite, I would say right here, look for your support and resistances. That 380 to the downside is definitely it. Okay. And another reason for that is one thing we're doing with these swing trades, which is really important. And I'm glad you I'm really glad you brought this up again, Sal, because you made me think of something else here that I want to talk about. And I hope I don't forget about it. Yes. When we were talking about these trades, this is nothing what I want. I'm trying to think and write at the same time, and I'm throwing myself off here. All right. What I was trying to say is, now with this type of pattern reversal, right? We've got a pattern reversal. You want to get be out if it breaks the previous day's low, all right? Especially for newer traders. So when I was talking about a trade, we're looking at a trade that goes higher, right? So if I'm looking at a candle that goes like this, right? And then the next day we talked about, we got that confirmation to the upside for this trade. Why does my pen disappear sometimes? I'm just really not understanding why my cursor's disappearing. Now I lost it altogether. Anyway, sorry guys. If this was a green candle, jeez, everything. There we go. Let's go. Now maybe it'll let me get my green. Yeah. So wait for the confirmation. You get that move, right? Now you get into this trade, or for whatever reason, what I would say is if it breaks below your candle that you were lining up as that support area, if it breaks below that candle wick, then that's where I pull that ripcord. Does that make sense? Because we're setting this up when it bounces off the support here, or off of a resistance. Well, if we set it up off of that one because it was going to roll over, that would be my out. And then then that would be my out, the previous day's candle, right? Continue with that. With us, we're looking at a bullish move, right? So my out, if it starts rallying up, my out would be if it goes below that 400 strike, really. But if it starts going down, my out is going to be about that previous day's candle, which is that 380 strike. Okay. So we're setting this up with market neutral for whatever our assumption is. As soon as it breaks out of that assumption, that's where we're looking to cover. That answer your questions? Anybody else have anything else? All right, if it helps you guys out, make sure you guys are subscribing, hit the bell, because I try to talk about this stuff in my daily market commentaries, or my spot the trades is what I call them. I talk about the trades that I'm implementing, when I'm implementing them, and then I talk about them when they're a pain in my butt or they're winners. And I talk about when I take them off and why I'm taking those off. So please check those out. Hit the bell, because I'm not really announcing those. I come in, it's kind of scheduled because you have to schedule with the powers that be on the interweb. But having said that, I can pop in at any time if I see something happening. All right. I was going to throw that out there, but it really isn't applicable here right now. So guys, here's what I got for you guys. Here is our offer. Make sure you guys take advantage of this. I'm going to throw it over there in the chat window right now, so you guys can click on that hot link to get this offer. 15 hours of content. Rising interest rates is around the corner. We're hearing about the Fed talk about this right now. And if you aren't worried about interest rates, well, you're going to really be sorry in about a year and a half if these interest rates start rising. Because my thing is, I think we're going to hold off on rising interest rates here, folks. And it's probably not going to happen until the second half of the summer. But when they start doing it, it's going to be incremental. We're probably not going to see 25 basis point move, which is, a quarter of a percent, 25%, or sorry, a quarter of 1%. They're probably going to be moving in 1% increments. That will decimate, folks, a portfolio. The other thing is I trade around the market profile, you guys. That tells me the psychology of the market. I think you guys should really follow some of the teachings of the market profile, because it really does hold weight. All right. And all kinds of other questions to answer for you folks on the when, where, and why we're trading options, and how best to trade them, best practices, all that stuff. It will take you to this page right here, and it shows a lot more going on there. One thing with our platform, folks, is when you've gotten this service, it's not going to go away. They got a little box that will allow you to check off when you've seen it. Basically, you don't even have to do anything. It'll just say, hey, you watch this video. So please send on the leap calls diagonals to teach. You're right. I haven't done one of those diagonals in a while. I think I did one for the swing trades a little bit ago, but definitely will be working around for those leaps. Thanks for the shout out there, Cecil. Appreciate you. All right, that's all I got. I hope you guys had something to take away. If you did, please smash that like button for me. Feed those bots. Share that information with somebody else. That's what that like button does. It wakes up a bot and it runs out there, finds somebody that it thinks looks like you and says, hey, maybe you want to watch this video. So that's how that works. Also subscribe, hit the bell, like I said, for some of the unannounced videos and some of these other videos we're doing. We're going to be doing interviews also. So if you want to check those out, more fun videos to come up like that. All right. That's it. That's all I got for you. Oh, one last thing. If you can't take that, take it easy. Bye for now.